Joining us with more right now is Jason Goldberg. He is Barclays senior equity analyst. Jason, let's talk about what's happening with the banks. We got better than expected results, I think, from every one of the banks that reported on Friday. Most of them closed the day higher in a down market. But it has not been a great year for the banks. You can go back to March and look at all of the concerns around the financial sector. You can look at the idea that we keep thinking we're headed for a recession and that you're going to see bad loans that are popping up. Where do things stand right now with these banks? Yeah, no,
certainly. You look at year-to-date relative performance versus the S&P 500. We have data back 80 years, and this will be the worst year on record at the year ended today. So certainly It has not been an easy path for the group. However, you look at Friday's results, and both net interest income and provision for credit losses were actually both better than expected. So I think a lot of the concerns around deposits that earlier in the year following the failure of Silicon Valley have certainly calmed down a bit. And while certainly we look for loan losses to continue to increase, they're going up at a measured pace, I think, allowing banks to kind of absorb it given their current earnings capacity.
You hear comments like Jamie Dimon, though, who's one of the best risk managers out there. And look, he's cautious about it. He's always cautious, I would say, to some extent. But how much of that is warranted? How much do you worry about some of these stocks and what's coming?
No, we certainly do. Banks are a reflection of the economy, and there's a lot of uncertainties given what's going on in the world right now. But as long as the Fed can engineer their soft landing, as several predict, we think this group will continue to remain soundly profitable and continue to grow, book value and recover kind of off the lows.
Goldman Sachs, Morgan Stanley, Bank of America, we're going to be hearing from all of them. I guess with Bank of America, it's going to be looking at their bond portfolio and the unrealized losses to this point.
Yeah, no, certainly. And if you look at all four banks that reported on Friday, you did see an increase in unrealized losses given the further backup in interest rates. However, that being said, the vast majority of these securities, it's a lot of mortgage-backed securities and treasuries, are maturing at par. So these unrealized losses will certainly dissipate as securities mature, or as rates eventually trend back lower.
I guess in each case, though, it's not that these banks are going to go bust as a result of them, but it will hamper what their earnings results are going to be because they've got these things tying them down.
Yeah, certainly, you have in certain cases low-yielding, longer-duration assets on the bank's balance sheets. But as long as deposits hold in, they don't have to necessarily recognize these losses. And banks have a fair amount of assets repricing higher, also benefiting from higher rates. So there's some puts and takes. Net interest margin bias is still be lower for the near term, but we think that's quite manageable.
What do you want to hear most from the three reporting this week?
Yeah, I think there's a lot of focus, on net interest income and deposits, credit quality, as you mentioned. And then, in late July, the Fed put out the Basel III Endgame rule, which is kind of updated capital proposal. And it's certainly something the industry is going to have to grapple with as risk-weighted
bankers don't like it.
No, it clearly, puts upward pressure on capital requirements. And it's something the banks are going to have to handle over the next several years as these rules come into effect.
So if these stocks have been massive underperformers this year, which, if any of them, do you like? What are your favorites?
Yeah, no, certainly we certainly have a bias. We did like the results out of J.P. Morgan and Wells Fargo on Friday with, as I mentioned, net interest income and loan loss provisions better than expected. As we look into this week, we think you'll see similar trends out of like Bank of America, where some have concerns, but we think you'll see continued high single-digit net interest income growth and loan losses remaining below historical averages.
Most of the stocks, or the banks that reported on Friday, closed higher. You pointed out the PNC did not. It was down by about 2 to 3%. What do you think of the regional banks? Maybe not the largest banks that are out there.
Yeah, so we think as this week goes on, we'll get some of the smaller banks report, and it's going to be a little bit more challenging, right? So net interest income will be down for we think almost all banks. Certainly many in the third and all in the fourth quarter. And as deposits continue to reprice higher, and the regional banks are just more exposed to that. So it's not going to be as smooth sailing from here, but it's certainly, the group has underperformed significantly.
The banks have been paying more for you to keep your deposits there. It's not the same as buying a treasury. You don't get the same sort of rates on that, but they have started paying up a little bit more just in terms of what you can get for a savings account or beyond. Is that a good thing, bad thing?
Yeah, no, so certainly banks are being grappled with higher deposit costs. But, one thing that you saw, at least the banks reported on Friday, is the increase in that deposit cost is beginning to slow. So while it's, pressuring net interest margins, that increase in deposit costs should begin to abate. And deposit costs tend to peak a quarter or two after the Fed stops hiking. And we're not sure if they're there yet, but we're certainly kind of closer to that. So I think that's something the group's looking forward to.